Welcome to the deep dive. We sift through complex sources, find those crucial insights, and, well, bring those aha moments directly to you. Today, we're really unpacking the thinking behind investing, looking at philosophy, performance, decades of lessons, all through Giverny Capital's 2022 annual letter. It's quite something, our goal, to pull out the key ideas on how they invest, how they did, and what they learned, making these, sometimes dense financial ideas clear and maybe even actionable for you.
Yeah, and it's a pretty unique source, isn't it? Not your standard corporate report. Giverny calls clients partners, and they're really open about wins and losses, their errors, that kind of honesty. It's rare, and it's how you really learn. Even the cover art feels different. Spectre V by Francois Lacasse sets a reflective mood.
Absolutely. And understanding the Giverny way, I think their origin story really helps. It goes back to 1993. Francois Lacasse, the founder, started managing his family's money, the Rochon Global Portfolio. And he was really drawing inspiration from the greats, right? Buffett, Graham, Templeton, Fisher, Lynch. After about 5 years of good results, boom, Giverny Capital Inc. launches in 1998. Makes you think, how much of that original DNA is still there?
Oh, completely foundational. That's where their whole partners philosophy comes from.
Yeah.
And they mean it literally. Client portfolios are managed exactly like the founder's own money. That Rochon Global Portfolio is the blueprint. It's not just talk. It's this core idea. Clients, managers, we're all rowing in the same direction. Builds trust, transparency.
And that trust is built on their fundamental view of the market, yeah. They basically say, look, short term, the market's crazy, unpredictable. 2022 showed that. But long term, it always gets back to the real intrinsic value of the companies. That's their conviction. Pick good stocks rationally, hold them, and the returns will follow. Sounds easy, but...
But sticking to it is the hard part.
Yes.
Exactly. It's about patience, ignoring the daily gyrations, seeing the long game.
Okay, so with that philosophy as their anchor, how did the flagship Rochon Global Portfolio actually do in the storm of 2022? The numbers for the year ending December 31st, 2022, show a return of minus 15.2%, which underperformed its benchmark. That was minus 12.3%. So yeah, down about 2.9% relative. A tough year on paper, but like you said, the story's always longer term, isn't it?
Always. You have to zoom out. Completely changes the picture. Since day one, July 1st, 1993, that's, 29 years, the compounded annual return, an impressive 14.5%. Now compare that to the benchmark's 9.0%. That's an annualized outperformance of 5.5%. And their goal is 5%, so they're hitting that long-term target. For you listening, this isn't just about Giverny. It shows that disciplined value investing over decades, it can work. It can beat the market, even with down years. And interestingly, the whole Canadian versus U.S. dollar thing, barely a blip long-term, like 0.2% positive effect annually.
That's a really solid long-term record.
Yeah.
What about their other portfolios? Same kind of pattern. Long-term wins despite maybe a rough 2022.
Pretty much, yeah. Reinforces the message. The U.S. portfolio also underperformed the S&P 500 in 2022 by about 3.2%, but since 93. Added 4.0% value each year over the S&P. Then the Canada portfolio, that one actually did well in 2022, beat the S&P TSX by 4.0%. And its longer-term record over 16 years, added a huge 10.1% annually over the benchmark. So the takeaway for you, Giverny is showing that a focused, concentrated portfolio, if managed with conviction, it really can beat the indexes significantly over time. Challenges that idea that you have to index.
Okay, let's shift to 2022 itself, the challenges. Giverny points to, well, everything. Ukraine, inflation sticking around, central banks hiking rates, recession fears. How do they try to navigate that mess, sticking to their long-term value approach?
Well, their playbook for inflation and recession is pretty consistent. They want businesses with strong competitive advantages. A moat, as Buffett calls it. Companies that can actually raise prices without losing business. That's key in inflationary times. They acknowledge central bank step in like 2008, 2020, and that helps. But they also warn about side effects. More inflation down the line, maybe, and investors getting maybe a bit reckless, thinking there's always a bailout. So for you, it's about looking for resilience in a business, not just a cheap stock price.
Right. And they were honest, though, saying 2022 performance relative to the indices was disappointing. They mentioned specific things. They avoided natural resources, low-growth companies. That hurt them relatively. And two stocks in particular, Meta and CarMax, really dragged down performance. You have to respect the honesty there.
Absolutely. Looking at sectors, they noted U.S. banks kind of benefited from rising rates, but then had to build up loan loss reserves. They expect a cyclical bounce back there. But what I found interesting was their take on housing, residential construction. Market values dropped, sure, but they see huge long-term potential. Massive pent-up demand. Like we're building maybe 1 million homes a year, but the U.S. probably needs over 2 million. That gap's been growing for like 15 years. It really shows how they focus on those big long-term trends, not just the quarterly market swings.
Yeah, and one place they did succeed was steering clear of those super speculative pockets of the market, stuff that crashed 60, 70, even 90%. They felt those declines were largely justified, which, turned out to be right. Okay, this leads us to a really core idea for them. How do you tell the difference between a stock that's genuinely cheap, undervalued, and one that was just massively overhyped and is now just, coming back to earth? They use this amazing, almost cautionary tale. Cisco Systems, remember the dot-com boom? Cisco stock went from like $23 in early 99 to $80 by March 2000, trading at 120 times earnings. Just insane. Then, bang, crashed to $10 in 2 years. And then for the next 14 years, it just bounced around $15 to $30, ended 2022 around $50.
Right. And here's the kicker for you listening. Cisco, it's a great company, grew earnings per share around 8% a year for 22 years, paid out billions in dividends. But if you bought at that peak in 2000, your total return, even after 22 years, still negative, about minus 20%. It's just a brutal lesson in the danger of overpaying, even for quality. And Giverny think a lot of those high-flying stocks from 2021 that tanked in 2022, they could face a similar long slog. Decades of going nowhere. It all comes back to Ben Graham's idea, their cornerstone, margin of safety.
Explain that a bit more. What exactly is that margin of safety principle? Cisco seems like the perfect anti-example.
It's actually pretty simple in concept. It just means buying something for a lot less than you think it's truly worth. It's intrinsic value. It's your cushion, your protection. If things go wrong, if your estimate is off or just bad luck hits, Cisco in 2000, zero margin of safety. The price was way, way above any reasonable value. So even though the business did well, the starting price killed the investment return. It means you should always look for that discount, that buffer, value first.
Okay, another area they dive into, warning it may cause drowsiness, which I thought was funny, is the real cost of stock options, ESOs. Buffett fought this battle years ago, right? Saying compensation has to be an expense. Gap eventually agreed, sort of, but here's the tricky part. Lots of analysts, even companies, report these adjusted profits that ignore ESOs. Why is that a problem? How does Giverny view it?
It's a huge problem because it hides a real cost. ESOs are compensation. They dilute existing shareholders. If you just pretend that cost doesn't exist, you're inflating your profits. It's misleading. Let's use Cisco again. From 2002 to 2022, 21 years, they spent $152 billion buying back stock. Why? Mostly to counteract the dilution from giving out stock options. Giverny did the math. The net cost of what they actually spent buying back all those shares issued via options, over 2.6 billion shares, was over $34 billion. But the amount they actually expensed on their books under GAAP rules, only $26 billion. That extra $34 billion, Giverny says, could have gone to dividends, to fuel cost to shareholders. So for you, the takeaway is, always look closely at those adjusted earnings. Understand if they're backing out real costs like stock options. Giverny counts them, period. They're an expense like salaries.
Makes sense. So, looking forward from that 2022 letter, their outlook for 2023 was agnostic. They saw the challenges, inflation, recession risk, but they didn't flinch from their strategy. Own quality, bought right, ignore the noise. And they shared their number one lesson from 30 years, didn't they? Trying to predict markets, worst thing an investor can do. So how do they stay grounded? How do they measure if the businesses are doing okay, even if stocks are down?
Yeah, they use something called owner's earnings, which comes from Buffett. It's a way to estimate how the intrinsic value is growing. Roughly, it's the growth in earnings per share plus the dividend yield. So in 2022, their company's intrinsic value, by this measure, grew about 5%, but the stocks, down around 20%. That tells you the underlying businesses were actually still chugging along, growing value, even while the market panicked. And since 96, they calculate their company's intrinsic value grew 13.0% a year. That's even better than the stock market performance of 12.4% over that time. It reinforces their whole point. Focus on the business performance, not just the daily stock quote. That's where long-term returns come from.
I found one of the most valuable parts of the letter was their 5-year post-mortem. Looking back at 2017 investments, that takes guts. They had a mix, right? Fruitome was a quick win, got acquired. Howden Joinery earnings doubled, stock barely budged. Analysts thought profits were too high, maybe temporary. Edwards Lifesciences' strong growth in earnings and stock, even with COVID disruption. And then Liberty Formula One, unusual for them, bought it when it was unprofitable, sold it too soon for a small loss, could have held on for much bigger gains. What's the big lesson for us from looking back like that?
Humility, definitely. And patience. It shows even the experts don't get everything right. And often the mistake isn't buying the wrong thing, it's selling too soon, like with Liberty. Or maybe not buying at all. For your own investing, it really hammers home. Know why you own something. Have conviction. and try to stick with it, even when it gets bumpy.
Yeah, and that learning theme continues in their Flavor of the Day section. They revisit past warnings about bubbles or speculative manias. Tell us about the Austrian 100-year bond and crypto. Those seem like perfect examples of ignoring value.
Oh yeah, the Austrian bond, issued 2017. By 2019, the price had soared, yield was tiny. Giverny warned it was dangerous. And sure enough, it crashed, fell 67% from its peak. Even if you bought it at issue price, you were down 14%. Add in Austrian inflation over that time, you lost nearly 30% of your purchasing power. Just chasing yield without thinking. Then crypto. Bitcoin down 64% in 2022. The whole crypto market cap dropped from $3 trillion to $800 billion. Huge wipeout. And the FTX collapse, valued at $18 billion, then bankrupt. It just underlines Giverny's point. They still avoid it. They see the value as, quote, totally arbitrary. The lesson for you is powerful. Understand what you own. Does it generate cash? Does it have real underlying value? If not, you're speculating, not investing.
Okay, but this next part might be the most insightful bit for any investor wanting to improve. Giverny's podium of errors. This is where they critique themselves, looking at mistakes. And they stress that mistakes of omission things they didn't buy often cost more than mistakes of commission bad buys. Let's start with the bronze medal, Texas Roadhouse. What went wrong there?
So Francois Lacasse studied the company back in 2017. Looked good on paper. Growing, decent valuation, earnings had quadrupled over a decade. But he never actually went to eat there and never experienced the product firsthand. He hesitated. 5 years later, 2022, stock's up 150%. The lesson for you. Sometimes it's not about complex spreadsheets. It's about that basic, real-world check. Don't let a small gap in your research stop you if the core case is strong.
Wow. Okay. Silver medal, O'Reilly Auto Parts. They actually owned this for 16 years, then sold in early 2020. Why? And why was it a mistake?
Yeah, they thought growth would finally slow down after such a long run. Big mistake. What happened? Pandemic hit. Demand for car parts went through the roof as people kept older cars longer. Plus, O'Reilly had pricing power. Business boomed. The stock more than doubled after they sold. If they just held the shares they bought back in 2004, a 4,100% total return. Mind-blowing. For you, it's a warning. Don't underestimate high-quality businesses, even if growth seems mature. Resilience and pricing power matter, especially in weird times. Don't sell just because growth might slow.
Ouch. That's painful. And the gold medal for errors, the biggest miss. LVMH, the luxury giant. This one's really interesting.
It is. They knew the company well, followed it for ages, admired the brands, the management, the competitive moat. Then during the Euro crisis in 2011, the stock dipped, looked reasonably priced, maybe 16 times earnings. They thought about buying, but they waited. Wanted an even more attractive price. Kept waiting for 3 years, never pulled the trigger. Since 2011, LVMH earnings soared. Stock went to €800 by early 2023, delivered over 20% a year for 11 years. The lesson for you here is huge. Sometimes pretty good is fantastic. Waiting for the absolute perfect price for a truly great business, you might miss the train entirely. Don't let perfection be the enemy of the good.
That podium of errors is incredibly valuable. And rounding things out, they mention a book published about Francois Rochon's career. It talks about self-determined companies. I guess that book digs deeper into these core values.
Exactly. And a central theme in the book and the letter is humility. It sounds maybe soft for finance, but they argue it's essential for being objective. And quote Eric Fromm. To be objective is possible only if one has achieved an attitude of humility. Basically, realizing you don't know everything.
That's a great quote. How does that humility translate into practical investing? What does it help you do?
Well, first, it helps you accept you can't predict markets short term, avoids that huge error. Second, it makes you admit the limits of your knowledge. Stick to your circle of competence companies you genuinely understand. And third, as we just saw with the errors, humility lets you actually see your mistakes and learn from them. It fuels improvement. Charlie Munger said Buffett's greatest strength is his humility, his constant learning, even after all his success. So for you, it's about staying curious, questioning your assumptions, not being rigidly certain you're right.
The book apparently sums up Rochon's career learnings nicely too. 1, buy good companies, hold them long term. Simple but hard because people lack patience, get emotional. 2, real outperformance comes from owning superior companies, those self-determined ones that control their own fate better. And 3, capitalism changes. It's really tough to know which dominant companies today will still be dominant decades from now. They mentioned Sears, Kodak, cautionary tales.
Right. And looking forward from that letter, Giverny felt good about their holdings. Exceptional companies, good leadership, solid growth prospects, reasonable prices, sticking to the plan.
So pulling it all together, what's the big message for you listening? Giverny acknowledges times are uncertain, but they ask, weren't they always? Their approach shows that building real wealth seems to come down to discipline, patience, focusing on that underlying business value, and being committed to learning, especially from your mistakes. Playing the long game. So here's something to think about. In this world of nonstop news, tweets, market chatter, how much of your own investing strategy, maybe even your life strategy, is really anchored by a solid margin of safety? And how much by the humility to learn from what happened yesterday instead of trying to guess what happens tomorrow?